In this video, you will learn how moving average truly work in the market, what is moving average, and a lot about moving average trading strategies. You will also learn how to add moving average on synthetic indices on MetaTrader 5, and I'll be showing you my magic moving average settings that I use to make profit in the market every day. And I'll also be teaching you the best moving average trading strategy for synthetic indices. This strategy is very, very effective on the chart. Pay attention to it and let's get to it. Alright guys, so today we are going to be learning about moving average trading strategy. And I tell you, this strategy that you're going to learn today works like magic. It's because of the love that I have for you guys that made me to upload this video on YouTube. This trading strategy is not just any strategy that you know on moving average. This strategy is different. Please, if you learn this strategy and you're not profitable, that means you don't know what you are doing in the market. This trading strategy is what I use most times to make money from the market. I use this strategy a lot to make money from the market. Don't play with this strategy. This strategy you're about to learn is going to change your life. I'm telling you from experience. Take your time. I don't know what you need to get, whether you're going to get your jota or anything. You can pause the video, go and get them and learn this strategy. This moving average strategy is very, very simple. It is very, very profitable. It's powerful and profitable in the market. Now, for a start, I will say a lot of traders, they used to downgrade traders that use indicators to trade. They think those traders that use indicators to trade don't know what they are doing in the market, or they are trying to find an easy way out. But that's not true. Traders that use indicator to trade in the market are also traders like you who are trying to make profit from the market. And if you check, some people think that they are better with price action trading strategies, so they are now superior to traders who use indicator trading. But the truth is that some people, they are using price action and still yet there's no action in their life. You are not profitable. How can you say you are trading liquidity trading strategy and every day you are like the liquidity in the market? The market is liquidating you all the time. So it does not matter if you are trading price action or indicator. The main thing is for you to know the exact thing that you are doing in the market. Do you know what you are doing in the market? And if you know what you are doing in the market, are you making profit from it? That is the main thing that matters in trading. So today I'm going to be teaching you this moving average trading strategy that if you use it, there's no way you can be unprofitable in the market. Your life is about to change in this video. Now, what are moving average? Moving average are indicators that help us to understand the trend and be able to take advantage from it. Now, this moving average has its own characteristic. It has its own ways in the market. If you are trading the moving average trading strategy, there are some things that you must understand before you start trading them. Number one is that when you see the moving average moving wide like this, you understand, when you see it moving wide like this, it means that you are in a trending market. When you see it moving wide without touching each other, for example, because me, I like to use two moving average to trade. If you use two moving average to trade, it is easier for you to understand what is going on in the market than when you are using one moving average to trade. So when you are using a two moving average to trade like this, you will understand exactly what is happening in the market. So when you are in a trend and the trend is moving smoothly, you will usually see the moving average wide they won't be touching each other. These lines will not be touching each other. You will see them very, very wide and moving in a correct way, like in a smooth way. But sometimes you see that the moving average is very tight. Like for example here, this one is trying to tell you that the market is moving in a very choppy way, or it is in a range. There are three trends in the market. We have the uptrend, and we have the downtrend, and then we have the range. But I don't consider the range among the trends, because the range is like a pause between the trends. So what do I mean? Sometimes you see the market moving in a trend. For example, like this, it's moving downtrend. So you now see at a point, you see some candles stop and then start moving inside the last retracement of the trend. So calling it a ranging market is because it has paused at this point here. The moment it breaks out of this point, it has continued the downtrend, and you see the market going down. So the moving average helps us to understand all those ranging parts in the market, because as traders, we are not here to trade the range, we are here to trade the trend. So your focus should be on trading the trend alone and not trading the range. This moving average has great advantages to us as traders. It helps us to understand when the market is moving purely in our direction, and when the market is just moving in a way to take out our money and take out our stop loss. Just like you can see here, this price movement is just moving in a range and choppy movement, and it won't be able to profit us. So that's the very great advantage of the moving average indicator. This moving average is like the mother of all indicators, because almost all the indicators are using moving average. Like a lot of them are using moving average trading strategy. All this moving average line. This moving average also have different type of moving average. So for example, we have the exponential, we have the simple moving average. All of them are moving averages, but they move different in the market. You don't need to know a lot of them like that. The only one you should focus on is the exponential moving average, because that is the one that helps us to get the trend faster. It is quicker, and it works better in the market. So the moving average, it works better when you use the exponential moving average to trade. Now, to get this moving average on your chart like this, all you have to do is go down to the indicator. You can see, so here you can add moving average. You can click on this, click on this F button, then you go down, you see moving average here, uh then you put the settings and you click on save. So I already have them on my chart, so I'm not going to be doing that. So right now I will show you the settings that I use for my moving average trading strategy. So the first thing I did was that I added the 45 period moving average. That's the first one, which is the red moving average that you see on the chart. This red moving average you see on the chart is the 45 moving average, and here is the settings for that. So you make your period 45, 45. Make your period 45, then leave the shift at 0. When it's time to choose between all these different type of moving average, click on exponential. You see here we have the simple, we have the exponential, we have the smooth, we have the linear weight. So for this strategy, make sure you click on the exponential moving average. When they say apply it to, you should apply it to close. You can apply it to a lot of things here, both high, open, low, and so apply it to close. With that done, leave every other thing the way it is. Make the color red so that you can understand it and flow with this strategy, and bring the size to this point. All right. So you save it. That one is the 45 exponential moving average trading strategy. Now, the second one is the 19 exponential moving average trading strategy, which is the green one on your chart right now. So to get that on your chart, all you have to do is make the period 19, the shift, leave it at 0. The method should be exponential, apply to close. The same thing with that one, only that this time around the period should be 19. Now, the style, you should use a green color to mark the style so that you can flow with my trading strategy and understand with everything I'm doing. So you don't need to be confused. So after doing all of that, you click on save and everything will appear on your chart exactly like this. If it's not like this on your chart, that means you have done something wrong. You should go and check it and confirm again. So now that you have this moving average on your chart right now, the first thing that you do is that you follow the rules of moving average. We have many rules of moving averages, but the few ones I have already told you already. So you should only try to trade the market when you see the moving average moving in a trend. Like, look at this. The moving average is flowing. It is not tight like this one here. Look at here. This one is very tight. But here it is opened and it is flowing. So only look for that open and flowing part of the moving average so that you can trade it. And there are many things that happens with the moving average. We have the moving average crossover. Some of you don't know what is a moving average crossover. This is the point where the moving average cross over each other. Like here now, you can see that there was a crossover here. At this point, there was also a crossover. What does this crossover mean? It means that the market is trying to change the trend. Just the way we have break of structure in other blocks and supply and demand and other trading assets, other trading strategies. We also have the cross for indicators. So when you see an indicator making this crossover like this, it means that the market is trying to change the trend for the market. For example, you can see that this trend was moving down. You can see it was moving in a downtrend, here. So for this downtrend to change, the moving average is now telling us that this downtrend is going to change, okay, because of this crossover here. So you can prepare yourself to understand that, you can prepare yourself to accept this new trend that is going to form, or to analyze this new trend that is forming. Sometimes it will not work and it will continue moving down, but most times during the crossover, you will see that the market will change direction and it will start moving in another direction. So let me delete this. Now, the same thing happened here. So right here, you can see that after this crossover, the market began to move down. Meanwhile, before that, the market was moving in an uptrend. You can see this. The market was moving in an uptrend here. But after this crossover, the market started going down. And look at how it went down with a lot of volatility. Now, let me delete this. So the same thing also happened here too. I'm telling you all this so that you can understand it very well when we start trading the main strategy. All this thing I'm showing you right now is for you to understand, because without this, I'm telling you all this so that you can understand it very well when we start trading the main strategy. All this thing I'm showing you right now is for you to understand, because without this, even if I start teaching you the main strategy, you won't be able to understand it. So right here, you can see this crossover here. And after that, the market moved up. Meanwhile, before this, the market was already moving down in a downtrend. But after the crossover, it started moving up in an uptrend. Now, even before this one started moving in a downtrend, there was another uptrend before. You can take a look at this. There was an uptrend here before, and after the crossover, here, the market started going down. So this moving average is very, very simple if you're using the right moving average, just like this one that we are using on the chart right now. Traders don't know about this trading strategy that I'm teaching you right now. A lot of traders don't know about this trading strategy, but you are very, very lucky to get it today, and I hope that you use it to do something profitable for yourself on the chart. Now, I told you guys that sometimes the markets can cross over. There is some weak crossover, and the market will not move down, like it won't change that much, and it will go back. If you check this, you can see that this was also a ranging movement. So you can trade a market like this one, and look at this place where the market uh, look at this point where the market crossed over and it started moving well. Now the thing is that when it crossed over here, the market was getting tight. It opened up a little and it continued moving tightly. But right here, you see the market has more space as it's moving up. But all the same, if you see a crossover on your chart, you should be very, very careful, and you should be anticipating either a change of the trend or a continuation of the former trend. So that's one beautiful quality about a moving average trading strategy. Now, how do we trade our moving average trading strategy in order to make profit from the market? What's the best way to trade this moving average trading strategy? Because I've told you guys everything. I've told you how the trend moves. I've told you the ones that you should avoid. But right now, how do we trade this moving average? The best way to trade this moving average so that we can make profit from the market. All right, I'll tell you that. So now you guys know about the crossover and the tight movements in the market, just like this one that you can see right here. So let me show you how we are going to be trading our moving average trading strategy to make profit from the market. All right, so here we are on volatility 75, and to teach you guys this strategy, I need to first of all start from the first step. So we are going to be taking it step by step. Let me give you the blueprint first. So to trade this strategy, there are three things you have to do. Number one is you wait for a crossover. For example, on this example that I'm about to teach you with right now. So you wait for a crossover. Look at this crossover here. After the crossover, then you wait for the market to make the first touch. Now, these two moving average that we have, they do different works in the market. The red moving average that you see here, this is the danger zone. You don't want the market to get to this zone before you take a trade. You should never take a trade when the market has touched this red moving average. If price touch this red moving average, don't trade it. That trade has been cancelled. So the only moving average that is going to give us our signal is the green moving average. But we have this red moving average here in order to protect us from false signals. So when we see market touching this red moving average, we are not going to trade it. We are only trading the market when it touches this green moving average. I hope you understand that. So the first thing you wait is do is that you wait for the market to cross over. Just like this, you can see the green moving average crossing over the red moving average, meaning that we are going for an uptrend. When you see the green moving average crossing below the red moving average, it means that we are going on a downtrend. So for this point now, you know that you're going for an uptrend. So this crossover is your first signal, is your first step. Once you see this crossover, you know that you are in for something new. Now, to trade this strategy, we are only going to be making use of a trend once. I know there are many traders that will tell you to trade the moving average, that each time it touches the moving average line you trade, each time it touches the moving average line you trade. But if you are trading this strategy, you are trading only the first touch of the trend. This way you are very early into the trend and you will be able to make more profit than the ones that will be trading during the trend. So you are the early bird, and them they can trade at any point, but they are going to lose a lot of money. So the best thing is to be very, very early in the trend. So when the market touches the green moving average, which is the 19 moving average, the 19 exponential moving average, that is the only time that you want to take a trade. And you're not going to take your trade blindly from that point just because the market touched the green moving average. Because even at this point, the market also touched the moving average, the green moving average, but it didn't go far. It's still hard to come down to this point to find a bullish candle. So when you see the market touch the moving average, the first touch of the moving average after the crossover, I repeat, the first touch of the moving average after the crossover, that is the moving average signal that you're going to take. And for this first touch to work, we are using two entry signals for this our strategy. The first one is the engulfing moving average. The first one is the engulfing candle. So we want to trade with the engulfing candle. Look at this engulfing candle here. This is the kind of candle I mean. I'm not saying that I should enter this trade. I'm just trying to show you the type of candle that I mean. This engulfing candle here. And the second candle that we can take is a pin bar. So this pin bar here, we can take this pin bar here as our signal. And we can also take an engulfing candle like this as our signal. So right now, when you see the market touch the moving average, this green moving average here, once it touches this green moving average here, then you know that you're going to take the trade. You understand my point? You know that you're going to take the trade once it touches this green moving average here and it gives us a signal, an entry signal. Let me show you another example of this. So in this example, you can see that the market crossed over the moving average here. The green candle crossed over the red candle here. And when it crossed over, the first price movement that touched the moving average was at this point. It was at this point that the moving average got its first touch. So that means that all these ones that move here, we are not interested in them. The only one that we are interested in is this one that touched the green moving average. So now, what does that mean? It means that once it touches this green moving average and it gives us an entry candle, that means we can enter a trade for this signal. Now, how can we take a trade on this signal? We wait for, so now we wait for this engulfing signal. You can see that we have the engulfing signal here. Now look at what happened here. Sometimes you can be waiting for a trade and just a little thing is going to spoil your trade. And it almost spoiled this trade here. You can see here, the market was very, very close to touching this red moving average, which is our danger zone. You can see it here. It's our danger zone. But we thank God I didn't touch it. And after that, we had an engulfing candle here. Look at this engulfing candle. Look at this engulfing candle here. We have an engulfing candle after it almost touched the red moving average, but it didn't touch it. So we can trade it with this engulfing candle. After trading with the engulfing candle, if it come back and touch this red moving average, it's not your business. As long as it didn't take the stop loss that you be placing below this candle here. So that one is not your business. It can move anyhow you want to move, or it will surely move to your take profit targets. Now let me show you another example of this strategy. So we have another good example here, and in this example you can see that the market crossed over here, and after the crossover, the candles didn't touch the moving average line until it got to this point. It was only at this point that the market started moving from there to, like, it was only at this point that the market touched the moving average line, which is our green moving average line. And luckily for us, we got an engulfing candle. So when you have an engulfing candle here, you have all the confidence to take your trade. You can take your trade with all your confidence. You can take your trade here. From this point here, you can take your trade. So let's say we want to take this trade now. What do we do? Like usual, I used to tell you guys, the first thing I do is that I understand my risk for the trade, and I do it very fast. There's no time. The market can leave you, so you have to be very fast when doing this. You place a limit order something at the point where the engulfing candle close, then you place your stop loss below it, because our stop loss is going to be below the last candle before the engulfing candle. So it will just be below that engulfing candle. So let's say you risk $10 for this trade, because our SL is now showing $10 for this trade. Let's say we risk $10. But if you don't want to risk $10 for this trade, you can risk more or less. Okay, let's say I want to risk $50 for this trade. So let me increase my my lot size. Let me increase my lot size and see how many lot size I need to get to $50 risk. So I need to get $50 risk. Okay, this one is too much. Let's try 0.16. Now it's smaller. Let's try 0.17. All right, now it's 50.55. I can go with this. Even if it's like 55 cents more than my risk, I can still go with it. It's nothing. So I now place my take profit target at the next high. So when you are trading this, you need to place your take profit target at the next high. That is, in an uptrend like this, you place your take profit target at the next high. That's where you take your profits. You can place it at the top here, or just here, so that you make sure your take profit target hits, or you just place it at a high there. And that's how you trade it. Let me bring this back, man. So the stop loss will be below here, just below the engulfing candle, and your take profit target should be at the next high. So for example, if I risk $50 for this trade, I'll be making $128 for the trade. That's a very sweet uh, risk management. So I'm making a lot more profit than my risk. So this $128, that is like I have made more than 2.5x. So that is 2 times my risk and more. That's what this risk is giving to me. Now let's see another trade. Now this trade happened today. This one that I'm showing you right now, this particular one, it happened today as I'm recording this video. So the market crossed the green line, crossed below the red line here, and from there the market returned to the green line. And you can see this is an engulfing candle. It's appeared after the market touched the green line, and from there you can see that the market moved down. I took this trade and I made some money from it. So you can just enter the trade from there. Once you see the engulfing candle, you enter your trade, then you place your take profit target below here. So that's how you take these trades, and it's very, very simple. Now let me show you another trade today on volatility 51s. So look at this particular one here. So I took this trade also. The market, the green line crossed my red line, below my red line, and from there the market moved up to my green line and gave me an engulfing candle. So I took the trade from there, and my take profit target was at this point. See, that's a lot of reward for my trade. So you can make sure you take your trade here. Your stop loss should be above it, and your take profit target at the next low. Let's kind of do like a back test of this strategy. Let's do it. Let's start from here. Let's look for trading signals. Now this one could have been a good signal, but it was not an engulfing candle, and it was not a pin bar. So that's the first one, and because of that, we cannot find any other trade for this particular trend again. Wait for the candles, wait for the moving average to cross, and look at the moving average crossed here. And when the market came here, it gave a pin bar, but this pin bar is not bearish. So we cannot take this trade too, because the pin bar is not bearish. This is a bullish pin bar. All right. So now we look for another cross. Here we have a cross. We have a cross here. Now this one did not touch the moving average, but this one did. From there we had an engulfing candle. Now this engulfing candle, we can now take a trade. Place our stop loss here. Our take profit target at the next low, just at this point here. That's great, and we'll make times 2 or more of our trade, of our risk. So from there, you now expect the market to, when the market crosses again, you start looking for your signals. And look at here, we didn't get any signal, so we can't take that trade again. So now here, the market crossed the lines, the moving average lines crossed. We have the green moving average below the red one here. And look at here, our engulfing candle showed up on the green moving average. And this is the first touch on the moving average. So we have our engulfing. So we can now take the trade, placing our trade here, our stop loss here, then our take profit target at the next low. And as you can see, this one was also a great trade. The take profit target was hit. Now let's look for other examples. So we are checking the market. We cannot take anything again until there's a cross. So all these ones, it's none of our business until we see another one. Now, the market crossed here, but right here there's no there's no entry signal when it touched the green moving average line. So we leave it. So that's it. That's how it works in the market. Now, if you want to join our VIP signal group, where I'll be dropping VIP signals and we'll be making a whole lot of money together with Deriv synthetic indices, the link is in our description box. And if you are new and you don't have an account with Deriv yet, you can sign up with Deriv. The link is in the description box too. So, see you guys in the next one.